Listen, we are talking about life and legacy, and we're really outlining some of the steps that we need to deal with as believers and even those who don't, because the Bible says it that we must leave an inheritance.
Those are the non-traditional long-term care plans, the ones that can be used for multiple things pretty much. And if you don't use it, if you never have a long-term care need, it could either be it could be a it could be a death benefit for a loved one, or in some instances you can't get your premium back. So if I'm 20, then and I want to be able to use something and I'm 40, well, it would behoove me to do it at my youngest and healthiest self. Why? Because that is when it's going to be the cheapest and the most cost effective. It typically, your health and again, a premium for a 21-year-old as opposed to a 41-year-old is going to be different because we got a 20-year age difference.
Good evening to one and all. CLCC, blessings to you and everyone joining us by way of YouTube, Facebook, and any other platform that you're tuning in on. Listen, we're having a marvelous conversation this month because we're speaking about life and also legacy. And this is one of the mandates of the gospel. God is a generational God, and he sort of links hand in hand with each generation. It's important for us to know that. And we must make plans, and we must put in place the principles and necessities so that we can have our legacy and also our life make the impact that God wanted us to have. The Bible says a good man leaves an inheritance for his children's children, for his grandchildren. So your life must exude and must be exemplary in the way that it impacts at least two generations and three if you can. Now, I want to invite everyone to the services 10:30 a.m. every single Sunday. And I also would like you to subscribe and to get regular updates from what we're doing here on YouTube and on any other platforms. So glad to see every one of you. Comment, share, invite someone to come along to what we're doing. Listen, I have in the studio a very special guest, and last episode was meant to be the last one, but we had to extend because of the powerful principles that we were unearthing. So, Andrea Hill is so glad to have you back.
Yes, and it's a pleasure to be here. I love that we're continuing and expounding on a conversation, and I feel like I couldn't get tired of talking about it because there's so many facets and there's so many areas and things to talk to. So certainly.
Wow, wow. In the last episode, we ended on whole life,
Hmm.
and we learned that whole life insurance is actually an asset,
Hmm.
because your life is basically the asset, and the amount of insurance or coverage that you have.
Hmm.
And so you have a cash value that runs alongside the actual insurance, which you can borrow against and can increase, particularly if you increase the premiums and different factors.
Hmm.
Am I correct in what I've said? Is
Yes,
there
yes.
this?
You can increase it. You can increase the cash value by overfunding. And the cash value can potentially naturally increase by the type of company that you are associated with. So, like I said, I gave you an example in the last interview. I am partnered alongside a mutual company. That's my primary carrier, but I provide access to other carriers through my brokerage. And with them, those plans have the ability to grow. The equity is not just what you put into it; it is yours. But it's if they pay out dividends, and then there are just some guarantees of that cash value growth. Like I said, by the time you are age 100, your death benefit, whatever that death benefit is, and your cash value will be the same, equal the same.
And so you said something that I really liked last episode. You said, be your own bank.
Mhm.
Can you expound a little bit more?
Well, yes, certainly. And so, this concept has actually been pretty popular, way before my time and probably before yours. If we've heard of companies like, not companies, but families like the Rockefellers, just extremely wealthy.
Rothschilds.
Yep, exactly. So just going to the Rockefellers, you know,
They
ca-
called it the waterfall method, didn't they?
they people call it all sorts of stuff. Okay, you hear infinite banking or banking on yourself or the waterfall method. A lot of times, cash value life insurance is used as one of the tools in that generational gifting and that planning. Okay, because yeah, you are creating a line of equity that you can utilize throughout the course of your whole life. So it's not just meant to be a death benefit, but it's also, not only do I have access to the tax free access to the equity that's growing,
So it's tax free
tax free. Okay, so that
because
means
it's a loan.
it's
All loans are tax free.
all loans are tax free. And if I have $30,000 in my life insurance plan, and I am going to buy a home and I'm going to take a mortgage out. Well, if I could do the down payment by taking some of the liquid from my life insurance plan, it just gives me more options and more access. I've created an asset to where it's not predicated on retirement age. It's not predicated on me needing to do credit checks. And this is my personal asset to where I can borrow from myself. I could be my own bank and I could pay myself back over the course of my lifetime because I want to keep this revolving line of equity to utilize it for whatever it is that I want to do, because it's going to not only give me a growing death benefit on myself, a growing death benefit on myself. It's gonna give me growing access to the cash value. But there are other things that are worse than death, like being young and not able to earn a livelihood due to illness or injury impacting it. Well, again, I told you whole life insurance is something that whole life is an insurance plan to life, because life is going to life, it's going to throw us those curveballs. Well, with having a plan like that, I have some living benefits that if I have some type of chronic care issue, it can give some resolve towards that. So it's not just one facet. It's not just a death benefit like how term is. Um, but universal life and whole life, they have this cash value element, and you have certain living benefits that can be included. So now I have a buffer that if something happens that impacts my ability to earn a livelihood. So you just have a multi-pronged approach.
So let's, for example, I've got a whole life
Hmm.
insurance. It's really great because not only are you insured to the amount you want to be insured, let's say 2 million, so you've got that guarantee, but then you've also got a cash value growing
Hmm.
beside it. So let's just say I've got 30,000 cash value.
Hmm.
How much would I be able to borrow?
You can borrow up to 90% of that. You just have to
90.
leave enough for fees. So you can leave 10% within it, but you can borrow up to 90%.
So I call up in the morning. I say, "Hi, Andrea. I've got 30,000.
Mhm.
I want 25,000.
Mhm.
How long does it take for me to get the 25K?"
Less than a week's time, about 3 to 5 days that they can either mail you a check or you're receiving it by direct deposit.
Wow. So I call up 5 days.
You don't even
Is it?
need me. You can call into the customer care, you can initiate your own policy loan, and there are no checks and balances because this is your dollars, and if you have the cash value there, then you have access. So you can simply
And how do I pay it back?
how do you pay it back? You you pay it back by there is no there is not a specific guideline or a structure or a payback period for
So I
that.
can just continue paying my premiums. I don't even have to overpay or do anything.
Right. Now you could now because now there is a caveat. Now the only caveat is that when you borrow from yourself, yes, interest, you want to pay yourself back interest. Now there are some people that use these plans and they have no desire to pay themselves back because they're utilizing it for what it is that they want to utilize it for. And maybe that's to supplement their retirement income because they can take $30,000 from here on an annual basis in retirement and they're not paying taxes and they may be getting another portion of their retirement income from somewhere else that is taxed. So depending on what your objectives are, all it does is it's supposed to run in tandem with it. Now, is there a certain payback period? No. So that's up to you to design with your agent or your financial professional based on the goals that you have and what you want to earmark it for, what you're using it for. So,
Wow.
oh,
So you spoke earlier about the Rockefellers,
mhm.
and I know they put together a very sophisticated system in terms of the whole life because they had all their family involved in that. Know
Right.
about that, or
I know very roughly about it, but I know that there was a trust piece of that
yeah,
because to do, to skip over a generation and to, to make sure that two generations, that is estate planning. And an attorney was obviously very instrumental in creating that, but that was the goals that they had. That's what they wanted it to do. But that's what a trust allows you to do. It allows you to, however creative you want to be with outlining certain things, that's going into the trust.
wow. So you got a trust and life insurance
Mhm.
working side by side and
Mhm.
creating this kind.
And there are different types of trust. Some people, there are life insurance trusts specifically. So there are situations where they're directly linked, but there are situations to where somebody may have a trust and it may not be necessarily linked with life insurance. But yes, so I just say you
Because
speak.
you can put all your assets in the trust.
Mhm. You can, and some people do that, and that's being depending on what state they're in. If they don't wanna worry about their heirs, maybe, state taxes in certain situations, they'll put their assets in a trust or.
Yeah, because it circumvents, it stops. We call it in England inheritance tax. What's it?
Mhm. Estate tax.
Estate tax. Yeah.
Mhm.
How much percent is estate tax here?
I don't wanna
Say wrong.
rock.
Probably about 20%, I should imagine. It's 40 in England,
I
so I
don't.
don't know what it is here.
Okay.
Over a certain
Right,
threshold.
right.
But yeah, that's a lot. Let me ask you this question. What age do you believe an individual should take out life insurance? Because um, typically, people get sort of around 40, usually, and then they think about it. Some in their 30s, but 40. But when do you think it's most important? Because you mentioned it being an asset.
Mhm.
And my knowledge always tells me when you're dealing with an asset, the length of there's certain factors, predominantly three factors in getting the most out of an asset.
Mhm.
One is time, one
Mhm.
is obviously money, and another is interest rate.
Mhm.
So, my without knowing that much about life insurance,
Mhm.
but it just tells me when I look at an asset, the longer you do it,
Mhm.
is the more exponential that asset grows.
Right. I mean, yeah, this is what I like to liken it to. You asked in a previous episode, should somebody have their life insurance running in tandem with their investments? So to kind of draw on that point, the can you bring me back to the point?
The point I was saying was, what age should a person?
Your youngest and healthiest age,
Okay,
okay? Being that it's on a mortality table, your youngest and healthiest age, okay? And so to liken it to investing, if you're investing, you're not investing with the chance that you're going to be able to pull the funds tomorrow.
sure,
It takes time.
to build
And
up the cash benefit.
and so the same thing would be said for this. So the younger and earlier that you start, well, there's a great chance that I'll be able to use it sooner because I've spent the time growing it out. Like you mentioned, the time, the money that I'm putting into it, and the interest that it's earning. And so if I give myself, if my time horizon, if I have a 20, 30 year, well, that's a longer time to grow something out. So if I'm 20, then and I want to be able to use something and I'm 40, well, it would behoove me to do it at my youngest and healthiest self. Why? Because that is when it's going to be the cheapest and the most cost effective. It typically, your health and again a premium for a 21-year-old as opposed to a 41-year-old is going to be different because we got a 20-year age difference.
So if someone at 20 says, okay, I want to take out a whole life
Mhm.
cash value insurance, the premiums throughout their whole life would be the set amount and it
Mhm.
would be much cheaper.
Yeah,
Ah,
it is. It is, but
so a 40-year-old would pay, let's say, $50. We're just using examples
Mhm.
here. And a 20-year-old, would they pay half or would they pay less than half?
They may pay less than half. They may
Yeah.
pay less than half because somebody's personal health. You can have a rating all the way from select preferred being the best to a non-smoker or a smoker, or you could be sub-rated after that. And so
But assuming both are healthy
Mhm.
at 40 and 20, what would you expect the premiums to be for the
It's
20-year-old?
gonna be
Half of the 40 or less than half?
half probably.
Okay.
Probably have.
Oh,
And not to say that because you can be in great health at 41. But again, the cost of insurance for a 21-year-old, just going off of the cost of insurance, it's going to be cheaper, much cheaper to insure a 21-year-old because they're much further away on the mortality table than somebody that's 41.
and then the 20-year-old will get the cash benefit much earlier in life.
They will, but Imma tell you this, because it's all measured on that mortality table, so the cash value, rate of return for somebody that is 41 is gonna work out differently because 41 to 59. So, the insurance company the face amount and that cash value are gonna equal the same at age 100. Okay. So that's a 59 year period to recoup that. Whereas with a 21-year-old, it's a 79-year period to recoup that. So that means that cash value is going to grow a little bit slower. Why? Because the insurance company has much more time to recoup that.
Ah, I understand.
Okay.
So the rate of return will be less.
It will because they're younger and they have many more years on the mortality table to but so
I
but
understand.
it's still gonna grow at a value that's in tandem because again with whole life that the whole North Star is that by the time this person is 100, if they have $1 million whole life, then the cash value is gonna equal that when they're age 100.
Wow. Do you deal with health insurance?
No, not necessarily, health insurance, but, no, I don't. I
Okay.
really in the scope of what I do now, there are some agents that have a practice where maybe, they do some of the Medicare supplements and things like that, but no, really what it is that I do is more so,
With
uh,
life insurance.
life and disability insurance or long-term care insurance, things of that nature.
Can you talk to me about disability and long-term care insurance?
Okay. So disability insurance is really more so individual disability insurance. It's a portable protection. Maybe your job has short term disability. Okay. And maybe it'll cover you through a period of 6 months.
Ah,
And they'll give you two-thirds of your income, but it's going to be taxed. Whereas you can create something portable, like how a basketball player or anybody, any skilled professional you want to protect your income earning ability. If I make $300,000 a year as an attorney, I want to protect that because
so this is disability insurance now.
it's
Okay.
disability. So disability insurance protects my income earning ability. So if I'm
Oh,
if
so that's my income earning.
right, so if I'm covering a portion of my income.
Sure.
So with that, you can create a plan that says, hey, if something happened to me, I'll basically I'll protect my I'll protect my income. If I need $5,000, if I need $7,000 because I have a mortgage payment, the children, it will ensure a tax-free payout for a length of time, 2 years. is the typical period,
Okay.
but you can create them to where, um, you know, if I never recover, then this can be something that's ongoing.
Wow.
This can cover me for a period of 2 years, for 5 years, up to 65, up to 67. So this is something where it's an individual disability protection that you put on your income earning ability, and it will basically, if I'm injured, if I can't do my work 6 months or more, then something what happens is this pays out for a tax-free period of time for that 2 years. And if after that 2 year period, depending on what type of plan that I've customized, if I'm a plastic surgeon, maybe I have some disability coverage that's solely for this occupation.
Sure.
And if I'm never in a capacity to where I can return to this, well, you can have some disability protection in place that, covers you all the way to retirement age. Again, it's just paycheck protection in the event that, again, I'm young, I'm not able-bodied, but I still have the bills, I still have retirement planning that I'm doing, I'm still paying off a mortgage. So it's just protecting a portion of your paycheck.
Okay, so it's a portion.
Mhm.
So if my company is paying me 50% of my paycheck,
Mhm.
then disability insurance will pay the other 50.
You can get it to supplement. So you can design it because this is
Or can I get the 50 from my job and 100% from the disability
You
insurance?
could, because if your job is doing some short term, well, that short term is probably only guaranteed for a certain amount to where, maybe 6 to 9 months. And what if, your event lasts longer than that? Well, that's when your disability insurance would be kicking in, and it's portable, outside of your workplace. So, however you have fashioned it, maybe you fashion it to be something supplemental because you have something at work and you just wanted to kind of gap up what you didn't. But maybe you don't have anything at work. And so, through this individual disability insurance, you're saying, hey, I want to make sure that $5,000, $7,000 of my income is protected on a monthly basis. And so you could design it that way. If you don't have anything, if they don't, protect you in that way at work. And a lot of times, we may not learn about the nuances of these things until we actually have to use them. And
Sure.
then we're at a disadvantage because now it's too late to do anything else.
Wow. So that's disability.
Mhm.
And the other one was,
Long-term care coverage. Long-term care coverage really talks to if we have some extended care event to where maybe I can't do two of the activities, the six daily activities of living. If something comes into play, whether I'm old age or whether I'm young, and it requires the aid of skilled nurses, or I have to be in some type of rehabilitation facility, or say,
stroke or something.
or yeah, or say I'm old age and now I need to be in a home of sorts. Um, Putting long-term care plans, whether we're talking about the traditional, where it's simply for in-facility type of care, or there are plans to where they're hybrid, to where they could provide some assistance for long-term care needs, or it's hybrid in the sense that it could be life insurance too. It could pay out a death benefit if it's not used for long-term care needs. So I do work with educating people on the plans that are traditional long-term care coverage, and then hybrid, the ones that are not just long-term care, but can also provide a death benefit or give you a premium back in the event that you don't utilize it for a death
Okay, so
benefit.
it gives you a premium back.
Those are the non-traditional long-term care plans, the ones that can be used for multiple things pretty much. And if you don't use it, if you never have a long-term care need, it could be a it could be a death benefit for a loved one, or in some instances you can get your premium back.
Wow, this is so powerful. Listen, we are talking about life and legacy. and we're really outlining some of the steps that we need to deal with as believers and even those who don't, because the Bible says it that we must leave an inheritance. So it's important for us to do that because the stats show us. Andrea told us last episode that only 8% of people actually in the community are insured, which means that 92 are not. And that's really tragic.
More so, we have an 8% inheritance rate. So
Inheritance rate.
right. So, people will have things through their workplace. They may have, little policies that they set up here and there, but something in the planning that they have done, only 8% of that's being captured.
So, what do you think about the workplace insurance? Because there's a lot of
Mhm.
workplaces that give life insurance, health insurance, and all these different other benefits. What's your thoughts about that? I have my thoughts, but I want to hear yours.
I say take the benefits that are on the table, obviously, always. But it's always best to have something portable. That way, if that job lets you go, or if you decide to change industries or what have you, you have something that is always with you. Okay. You control it. A lot of times with job place insurance, it's some group term coverage. Okay. You probably didn't really even do any underwriting for it. And again, if you were to leave that workplace, it's 9 times out of 10, it's not going to follow you. It's only for that particular
So it's
role.
almost like a term
It is.
insurance
It
because
is.
the term insurance expires after a certain time, whereas the job insurance is with you as long as you have the job.
Right.
So if you're with that job for 20 years and then you leave that job and then you think, oh, I'm not insured anymore, and you go out to get insurance, the premiums are going to be high,
Right.
could have issues. Whereas if you was in the job and you had personal insurance alongside the job insurance, you would pay a lesser premium.
That or again, the thought process, you don't wait because we don't have a crystal ball. I'm healthy today, but
That's the
by the
thing.
grace of God do we go. So because I'm healthy today does not
At it
mean
today. Yeah.
that I'll have that same health in 5 years, in 7. Like we don't know. The littlest thing could, knock us off a certain trajectory or pathway. And so you don't wait. You always have something in tandem with your employer that you can control because again whatever it is that they're offering, it's not something that's going to grow in value. It's not something that is portable either if you were to leave that workplace. So it's always best to have something that you set aside because there are a lot of people, if you retire, you don't get to retire with that. And if sometimes depending on the company and the benefits that they got, but even if they were able to, more than likely it's gonna be something small for final expense and not necessarily to make your family whole.
Oh, so you said it would be a small payout.
Just meaning that if you were to retire and
Okay.
in their retirement, that particular company gave you something. Typically, you don't when you retire, you don't leave with, your coverage.
So you said that usually at the workplace it's group insurance and there's not been underwriting. What are you getting at there?
Well, so 2 things. So some companies do group term, and then some companies do have things like employee whole life benefits. Okay, so when you offer employee whole life, it is going to come with some underwriting. Whereas with that group term, it probably is not going to come with any underwriting, and it's going to be something that's customary that the your company is offering. But again, the second I leave that, I haven't even done any, like, individual underwriting.
I understand.
You understand? I'm not gonna leave with that.
So I have to do the underwriting when I leave. That's the point.
Right,
Make
is what would happen. So why
or
wouldn't
made redundant either way.
why wouldn't it make sense just to have your own portable life insurance and whatever the company wants to give you in addition, cool. Because while I'm there, I'll have it. But if the second I decide to do something different and I leave, it's not gonna go with me.
So the whole life if I'm working at a job and they give me whole life,
Employee whole life, yes, because
when
you
how does that stay with me even after I've left?
yes.
Oh, that's a good one then.
Yep, yep, but that it does require some underwriting. The the insured, the employee is tasked with paying for it, and so but yes, but that's great because it is portable, and typically with employee whole life, it's a more simplified process. It's probably not a full out underwriting process as somebody that wasn't associated with the company now is trying to get
So
insurance.
would you advise those who are watching to go to to go to their job and say, "Listen, can you swap this life insurance for whole life for me?" Or would that be a bit of a no-no?
No, I don't think that would be a no-no, and I think that depending on, what the company is doing and if they are, interested in being able to provide more benefits and values to their employees, these are great ways and great tools that can help retain people, like Keyman Insurance that we mentioned in 2 episodes back. But I think that it would to be honest, it wouldn't be a lot of cost to the employer. It would
So you're
really
doing it as a group package.
it right, but it really the for employee whole life, the cost is associated it's with the employee.
Okay, I
Okay, but
understand.
it allows some simplified underwriting and it is a plan that is transferable. So if I leave them, I still have that growing in value.
Sure.
And if I want to add some more with another plan, I can.
So we're encouraging employees watching to knock on their their superiors' doors and saying, "Listen, can you swap this to a whole life?" Does that have cash value, the one with the employee?
No.
Ah,
Typically term because it's term. So even if it's a group term, like it does not build in cash
the
value.
whole life one.
With whole life, yes.
So even the employer
Mhm,
whole life has a cash value.
mhm. Yes.
That's good.
Yep, it's a permanent insurance. So, yes, that is going to have cash value, is gonna grow in value, whereas the group term, it will not.
Okay, that's interesting. So, what other insurances are out there that we've covered? Key man, we've covered disability and and the variating life insurances.
Mhm.
What other insurances are out there that you think are important in terms of people? You know what people need to have.
Again, it's gonna be the 3 things that we've kinda already touched on. Anything that is gonna, give me more, protection against death, illness, injury. So, again, those big 3, it's gonna be life insurance, it's gonna be disability insurance, it's gonna be having long-term care protection in place, because
What about funeral? There's some sort of a funeral insurance, which I think is important as well, actually,
right,
because I see too many people on the GoFundmes and trying to, gather. The family are grieving, and then they're trying to gather funds together to
right,
alleviate this funeral cost. It's very, very difficult, a difficult period.
right.
Um, what's your thoughts about that? And is that a policy as well that your
So
expertise do?
Going back to that 8% inheritance rate,
Wow, that's
it,
shocking,
it
actually.
it's just something that is in the planning right here. And so I run into this often too. It feels like the knowledge around it. So final expense plans. So historically, people of color, for a long period of time, they talked about how we weren't allowed to be insured for over certain thresholds. A lot of what we were getting were final expense plans, plans that are 10,000, 20,000, 30,000. Well, those expense plans that we get through these insurance companies, they're supposed to be for that in addition to any other generational gifts or things. And I feel like sometimes that gets lost in the shuffle. Um, you know, Here in the States, our grandparents, our older our elderly family members, they will have, their plots already secured at funeral homes and
Sure.
maybe there's some type of arrangement, but a lot of times those arrangements are left to the people who those insurance proceeds get paid out to. So if you're leaving beneficiaries, I feel like this is a part that gets a little bit lost. I feel like people that are naming beneficiaries, if you don't have a final expense plan in place that you have created with with a funeral home, then the proceeds that are coming from the payouts that the insurance
Go
company,
to the beneficiaries.
yeah, and the beneficiary is tasked with handling those final expenses.
Ah, so it's better to have it pointing towards the funeral home so it's all paid for and
Well, somebody's still gonna have to
manage it.
right. So no, I don't necessarily think that that is the best way to go. But there have been all sorts of things that people have done over the course. Just meaning that there are some people that broker these deals with funeral homes, but there are some people that they can have these deals, but maybe the final expense plans that they buy with the insurance carrier, maybe they're not fully breaking down to their beneficiaries. Hey,
This is what it
you're the recipient of these funds.
I
And so now
this
you're
is what I
tasked,
expect you to do.
right? Because what I hear a lot of times, and it's probably left a bad taste in people's mouths too. People get mad with their relatives and their family members because they're like, you didn't do what you were supposed to do with the money. And it's like, I don't know
Does
if
your company ever get calls on that, or have you ever had
I've never
disputes? Okay.
I've never had a call or dispute with regards to it. But beneficiaries, that the contract holder of the life insurance policy, that's for them to do.
Sure.
And so they're the only ones that can name a beneficiary. So they do. But again, it's just about vocalizing what else you're supposed to do, because sometimes people just receive this money. They think that it's a free for all, that, Uncle Joe loved me so much that, versus all his other, nieces and nephews, even though I was the most responsible one,
Right.
that's probably why he paid it out to me so that I could do the business that I'd be tasked with doing.
Wow. So what how long does a payout take? So the insurance company is informed that so and so has passed away. How long does the money take to come to the
Well,
beneficiary usually?
with the company that I'm affiliated with, 7 days, if not sooner.
That's
If
pretty
we're not
quick.
mailing a check, but that's after you have started a claim. That's You have to provide a death benefit. I mean,
Certificate. Yeah.
a death certificate. After done that, and okay, everything checks out. It should be 5 to 7 days, if not, again, that timeline. So whether it's mailed to you or somebody delivers it to you in person.
Oh, sometimes they deliver it. Wow. What, someone from your company?
Yeah, one of us agents.
Really?
Uh-huh.
Wow. So you've done that.
I have not,
Okay.
not just yet, but
Okay.
I'm still very new in my career, 3 years, so I haven't. But that obviously we know that in time that will, because that's just the nature of the business that I'm in.
Yeah, sure. So you've been with this company for 3 years.
Mhm.
Wow. But you've got all this vast knowledge, which is amazing. But you've obviously gained this knowledge over a
Right.
much longer period of time.
Right. It's interesting because prior to getting starting and having my own insurance and financial services practice, um, I was a property adjuster here in New York City. And what it is, homeowners, they call me when something, they're putting out fires in their home. And so I tell people, and that definitely gave me some nuance, because that's already insurance. It's just a different side of the house. People coming to me to help put the fires out in their home. And so I tell people, now I get to do something even more impactful, helping people to avoid fires in their financial homes. And that's simply sometimes what, you know, put in timely information in front of them and giving them access. Because I notice that a lot of times in our community, we have barriers because of that. We're not open to having discussions and learning about these different things that we can put in place to ensure our financial house.
Here's my last question, and it's been fantastic. I'm so sorry to say my last question, but w- somebody who's watching, they want a reliable, good insurance, either broker or company. What criteria should they be looking for? Because I mentioned in I think 2 episodes ago about someone who was insured and the small print stopped them from getting the payout they expected.
Mhm.
So what would you say one would should look for in a broker and an insurance company?
Well, I would always say I start by saying, do your research. You
Okay.
can't solely, rely on somebody and use all of someone else's brain function and power and say, hey, we don't put all our eggs in one basket ever. And that is even with the people that we do business with. Don't
Take
again,
things on face value.
right, do your research and
Yes.
then after doing your research, identify whether that is okay, this company is pretty reputable. Let me check into them because I know that they've been around for 180 years and they're not a fly by night type of operation. And so I would look at that. I'd look for companies that have staying power, that have a track record and a historical record of just having a solid, incredible reputation, number one. Um, well, research is where it's gonna start from. My own knowledge with it, and then the
What are they
companies.
looking for when they're looking at research? So they're looking at reputable company,
Mhm.
been around for a long time, triple
Financial
rated.
yeah, financial ratings are good, and just again, just the historical, like the reputation, okay? There are certain carriers that have had a lot of, I don't wanna say volatility, but just meaning changes, like maybe their rating class changed, maybe they were a double A, and then something in their business structure changed them, downgraded them. So
I tell you what's also important, good customer service. Because
yes.
nowadays everything is, you know, talk to the chat bot, and, leave a message and you can't talk to people. And I'm like, you know what? I love all this modern day, robots and stuff, but sometimes I just want to talk to someone,
Yes, but
especially when it comes to finance and those sort of things.
and it's so interesting
Give
because
me a human.
some people think that they can just type it in online and get a response. They listen to the ads late at night. I would say make sure that the person is knowledgeable. That's why I'm saying do your research so you can have a basis point and you can ask pointed, informed questions to check their knowledge. If this person is not knowledgeable, okay, I'm looking for a company that has a good reputation and then the people that work within the company. If they're not knowledgeable, if what they're saying is not trustworthy, if they don't know, like then I don't wanna be affiliated with that, so I would do my research in first finding the institutions that align with, whatever my personal, uh, my
Eyes are.
yeah, my desires, my objectives. If that's cash accumulation, then, it may behoove me to go to somebody that has a good financial rating. Whereas if I'm just looking for a death benefit and I just wanna make sure that me and my family have a peace of mind, it may not be as involved, okay? But again, I'm looking for reputable, credible institutions, and I'm looking for reputable and credible professionals that come from these institutions to be able to give me some value add.
Like yourself.
Mhm.
Yeah.
Mhm.
Where can people find you? This has been excellent. Thank you so much
My
for coming on.
pleasure.
We have been informed and enlightened. So where can people find you, Andrea?
Well, I'm online. I have social pages. I'm on Facebook, Andrea Agent, Andrea Hill at NewYorkLife.com.
That's your professional page.
That's my
Yes,
professional
don't
page.
go to Andrea's personal page.
Go to my Facebook page. I'm on LinkedIn, Andrea G. Hill, agent at New York Life. Yeah, so I'm online and then email. Email is one of the best and fastest ways to get in contact with me if we're looking to set up an appointment to discuss some objectives that you may have. The best email address for me is aghill at ft.newyorklife.com.
Amen. What a wonderful, wonderful episode. Again, we've been discussing life and legacy and how we must live a life as an example, but we should leave a legacy, which is important. God said to Abraham that your seeds will be like the stars in the sky and like the sand on the seashore. So he left the legacy that we're still speaking about today. And most of the characters in the Bible, positive ones, left a good legacy, and that's what we're called to do. I want to invite you to our service 10:30 a.m. on Sundays, CLCC. The information is on the screen. And come along, bring somebody with you, be blessed, uplifted, encouraged, and motivated so you can move to the next level. Father, we thank you today. We give you the honor, the glory, and praise. Thank you for everyone that has joined us by way of online. And I pray you bless them, that they would live a life of legacy and that they would make impact in all that they do. In Jesus' name, amen. God bless you, and we'll see you soon. Thank you, Andrea.
Okay.
Bless you.
My pleasure.